It's time to explore the financial benefits associated with the modern-day oil boom that is sweeping the nation. Get ready for Crude Awakenings with Brandon Cox.
Anytime you're investing, you want to do the best you can to mitigate the risk associated with that investment. And Chris, I mentioned earlier on in the show that you're a huge part of our risk management team and having that piece in place for not only us as a company, but those who partner up with us. Because I know a lot of people have the understanding that, well, if the price of oil goes down, then I'm up, I'm not in a good spot. So Chris, why don't you share with them kind of the hedging strategy and the risk management place that we have in place to protect us, and kind of walk people through that so they understand that we're not just kind of floating in the wind here and basically exposed based on however the wind is blowing, whether that means higher oil prices or lower prices.
As a risk manager, when you go to bed at night and oil's trading up, you don't really worry about that because the companies that you're dealing with are making profits. What we worry about every night going to bed is what's that one exogenous event that could really change the price of crude, in a heartbeat. And, look, geopolitical risk, certainly, if Middle East becomes very unstable, then you get higher oil. Well, that's great. And, we want to put our companies in a position to benefit from that. But at the same time, if you take a look at the Lehman and the financial meltdown that we had in '08, you could certainly see crude oil go from about $147 to $30 in the blink of an eye. And so those are the kind of events that we worry about. We look at, is China, what's their liquidity issues today? What's going on in Europe? Spain, Greece. Are these events that could trigger another major sell-off? What the U.S. is going to look like when we start tapering off, QE infinity. So these are all things that we constantly think about. We put in our models, and so what we're looking to do is put on hedge strategies that will let you benefit for oil going up. But if oil begins to really drop off in an aggressive fashion, how can we lock in a certain price deck or price level that we'd be comfortable with that would maintain strong cash flows in the event that oil did go, say, from $100 to $50 a barrel. So we do that using collars. We'll go out there and if oil's at 100, we can write $125 calls against $75 puts, which would basically, anything between 75 and 125 would be floating rate. If oil got above 125, we'd be locked in at 125, and if oil went below 75, then we'd be locked in at 75. Costless collars is a big strategy that we like to use. Certainly it has its benefits. And when you look at, direct investments in oil companies, cash is king, cash flow is king. And so to be able to, lock in a minimum amount of cash flow based on what you're producing is certainly an attractive feature for a direct investment.
And is that pretty common for other oil companies out there? And I'm setting you up here. It's pretty obvious, but I want to help the listeners understand once again that not all oil companies are created equal, and that applies on so many different levels within the company, from the management team to the field operations. And once again, this piece that you specialize in, Chris, and how you've kind of built your career around it, is that something that's common in privately held oil and gas companies that are out there?
I would like it to be more uncommon, but certainly not common at all. The players that are in the hedge markets are going to be major energy producers and end users. So you're looking at like BP, Shell, and these large multinational companies that have the resources and the sophistication to hire the brain power to do it. But once you start getting into the smaller type energy producers, I would say 1 out of every 10 would probably be an aggressive stat. I'd say easily less than 10% probably of junior-sized companies engage in it because, look, it's a sophisticated market, and the relationships and the infrastructure that needs to be built in place is certainly no small task.